Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Atkore Inc. quarterly report. Atkore Inc. offers a diverse range of products and services across various industries. The company's electrical segment provides metal electrical conduit and fittings, plastic pipe conduit and fittings, electrical cable and flexible conduit, and international cable management systems. In addition to these offerings, the safety and infrastructure segment includes mechanical tubes and pipes, metal framing and fittings, construction services, perimeter security, and cable management. The company serves a broad range of end markets, including new construction, maintenance, repair, and remodel, as well as diversified industrials, alternative power generation, healthcare, data centers, and governments. Atkore Inc.'s products are sold under various brand names, such as Allied Tube and Conduit, AFC Cable Systems, Caftec, Heritage Plastics, Unistrut, Power Strut, Cope, US Tray, FRE Composites, Calbond, and Calpipe. The company's extensive product portfolio caters to the needs of various industries, making it a one-stop shop for customers seeking electrical, mechanical, safety, and infrastructure solutions. With its global presence and diverse range of offerings, Atkore Inc. is well-positioned to meet the evolving demands of its customers across different sectors. The stock price of Atkore Inc., ATKR, has experienced a decline over the past year, with a reported minus 15.41% change, according to investing.com, and minus 16.02% change as per TradingView. However, there have been instances of short-term positive movements due to specific news events. One such instance was on February 3, 2026, when Atkore's stock rose by 2.46% in pre-market trading, after the company announced its first quarter fiscal year 2026 results. The company's earnings per share and revenue significantly surpassed analysts' expectations, with an EPS of $0.83 and a revenue of $655.5 million. The positive sentiment was fueled by a 2% increase in organic volume and productivity savings, exceeding $30 million year-over-year. Management also maintained its estimated range for fiscal year 2026 adjusted EBITDA at $340 to $360 million and adjusted net income per diluted share at $5.05 to $5.55, signaling confidence in future profitability. These positive news events have contributed to the slight increase in Atkore's stock price over short-term periods, despite the overall negative performance over the past year. The primary drivers of revenue growth or decline can be identified through a thorough analysis of various factors. On the one hand, revenue decline is primarily driven by a decrease in net sales, gross profit, and average selling prices. This indicates that companies are struggling to maintain their market share and pricing power, leading to reduced revenue. On the other hand, revenue growth is largely attributed to increased sales volume and improved operational performance. Companies that have managed to increase their sales volume have seen a significant boost in revenue. Additionally, effective cost control and improved operational efficiency have also contributed to revenue growth. These factors suggest that companies can drive revenue growth by focusing on increasing sales and optimizing their operations. The net income of a company underwent a significant decline between 2024 and 2025, decreasing by 67.5% from $46,336,000 to $15,034,000. This substantial drop in net income is largely attributed to the decrease in operating profit margins. In particular, the gross profit margin decreased from 25.8% in 2024 to 19.1% in 2025, while the operating profit margin dropped from 10.2% to 3.1%. These declines indicate a reduction in profitability for the company over the given period. The primary reason behind this decrease in net income and profit margins is attributed to decreased operating income. This may be related to changes in operating activities such as accounts receivable and inventories, which could have had a negative impact on the company's financial performance. The company's financial performance is a cause for concern. According to the extracted summary, the company is not generating positive operating cash flow. In fact, the data shows that operating cash flow was negative in 2025, with a net cash provided by operating activities of minus $55,497. This indicates that the company is struggling to generate sufficient cash from its core operations, which can be a sign of underlying issues such as inefficient management, poor sales performance, or high operational costs. The lack of positive operating cash flow can also make it challenging for the company to invest in growth initiatives, pay off debts, and reward shareholders. While more detailed information is available on the components of operating cash flow, the overall picture remains bleak. The absence of a positive net cash provided by operating activities suggests that the company needs to address its operational inefficiencies and improve its financial performance if it wants to achieve long-term sustainability. The company's debt level and interest expenses have undergone some notable changes in recent periods. Notably, the total debt has increased by $521,000 as of December 26, 2025, compared to September 30, 2025. However, this increase is relatively small considering the overall debt amount. On a more significant note, interest expenses have decreased by 16% to $6.9 million, indicating a reduction in financial obligations for the company. This decrease in interest expenses suggests that the company may be benefiting from lower borrowing costs or improved financial management. Overall, while there are some areas where debt levels and interest expenses remain unchanged or lack information, these changes indicate a positive trend for the company's financial health. Management is providing a clear outlook on the company's strategy and financial position. One key initiative is the adoption of new accounting standards, which will impact income taxes in fiscal 2026 and revenue from contracts with customers in fiscal 2028. The company is also facing challenges due to lower average selling prices and higher input costs, which are impacting its outlook. However, management is taking proactive steps to mitigate these effects by considering debt repurchase or refinancing to reduce the debt burden. In addition, capital expenditures will be necessary for expansion and updating production capacity, indicating that the company is committed to investing in its future growth. Furthermore, management is confident in the company's liquidity position, stating that it has sufficient funds from operations, cash on hand, and borrowings to meet its needs for at least 12 months. Overall, management's comments suggest a focus on adapting to changing market conditions while maintaining a strong financial foundation for future growth. The company has a history of rewarding its shareholders through both dividend payments and share buybacks. In terms of dividends, the company has consistently paid out significant amounts to its investors, with $11,138 being distributed in the 3 months ended December 26, 2025, and $11,121 in the same period the previous year. In addition to paying dividends, the company has also engaged in share buybacks. Specifically, it has mentioned share repurchases in its liquidity and capital resources section, indicating that it has been actively purchasing back shares from the market. This suggests a commitment to returning value to shareholders through both dividend payments and strategic share management. There are valid concerns about inventory buildup and potential disruptions to the supply chain. The company's current inventory levels, totaling $10,227 net, indicate a significant accumulation that could impact future operations. Furthermore, there are several factors that pose risks to the supply chain. Global conflicts and other external factors can disrupt global supply chains, while adverse weather conditions can affect domestic supply chains. Additionally, interruptions in facility or supplier operations can reduce production or distribution capacity, further exacerbating potential disruptions. That concludes the financial summary for Atkore Inc. Feel free to comment below, and I will be happy to answer them when possible.